Good day, everybody. I'm Nick Sargent, an economic consultant to Fort Washington, and I'm joined today with two of my colleagues, Dan Carter, who's responsible for fixed income investing and is an astute Fed watcher, and Austin Coomer, who is involved in investment strategy and implementation. The goal today is to really update the assessment that I gave in the first presentation shortly after the November elections. So just to summarize, my main message then was that 2020, as we all know, we were in uncharted waters. The first major pandemic in 100 years, unprecedented shutdowns that produced a steep decline in US and world economic activity. The good news was there was massive fiscal stimulus and Fed actions that helped to get us past that. And in the second half of the year, we saw a strong recovery. And basically, the stock market mirrored the pattern of economic activity, first plummeting and then rebounding. So in the presentation, I was presenting our outlook for 2021. And I think that the main message was that there were grounds for optimism that the recovery would continue through this year. And there's even hopes for return to normalcy. And the principal reason being, as we all know, coronavirus vaccines are now being disseminated. It's going to take a while to get it through the population as a whole, but there's basis for optimism that we will be along the way by the second half of the year, which is when we're looking for the economy to get added impetus. So in the meantime, though, there was one other development of note, and that was that Congress was able to pass legislation to deal with the immediate problem that some people on unemployment would have lost their benefits. And a $900 billion COVID stimulus package was enacted. And the good news is that, and I'll go through this, that even though the COVID situation has worsened in terms of cases, hospitalizations, and deaths, that package is expected to lift GDP by as much as 3% on top of what was the case before, and should help tide us over to the second half. So I would say ourselves, most forecasters, if anything, are upgrading the economic forecast to some degree. So that's where we were. What I want to now switch to is how the political landscape has changed in these last 2 months. And in a nutshell, we know that the Biden administration was seeking to reverse many of the policies that were enacted during the Trump era. That's why it was such an important election. And Biden, in the campaign, announced some major initiatives that he was seeking to have enacted. But when we got the initial results of the election, it seemed that we had a divided Congress. That is, the Democrats would still control the House, but by a narrower margin than before. But it looked at the time that the Republicans were going to keep control of the Senate. The vote at that time was 50 Republicans versus 48 Democrats. But there were the elections, runoff elections in Georgia for 2 seats. And the question was, could the Democrats pull an upset and win both of them in the Deep South? And so, lo and behold, that's exactly what happened. And so the Democrats now, with a 50-50 situation, still now gain control of Congress because Vice President Kamala Harris, the President Pro Tem of the Senate, can cast deciding votes. So, as a result of this, I think that now we've got to reassess the view that gridlock is going to prevent legislation from being enacted. And so what I plan to do today is just take you through our take right now as to what we see as the possibilities for some things being enacted, and where we see more resistance still as the most likely outcome. So first and foremost, as soon as President Biden is inaugurated, he's going to announce his 100-day plan, and he's left little doubt that his top priority is still getting more economic stimulus to counter the impact of the COVID-19 resurgence, because there's no doubt we've seen some slowdown of the economy in the last few months, and it's likely to linger into the first quarter. So what specifically are we looking for? And here, there's a little doubt that Democrats had two things on the agenda that didn't get enacted in the COVID relief bill in December. One is that they favored checks to eligible individuals, and this was basically people with incomes, say 75,000 or less. And what Congress enacted was a relief package for individuals of $600 per person. The Democrats are seeking larger amounts in the vicinity of $2,000. So they're certainly likely to press for that. And ironically, this is one area in which President Trump actually agreed with the 2000 stimulus checks. The second major area is that the Democrats feel that there is need for considerable more support for state and local governments who have been hard hit by the pandemic. The Republicans sought to block this, but with the Democrats now in control of both the House and Senate, there's more likelihood of enacting some, activity, some areas there. So this is what I think is most likely to occur. The question beyond that then is, what other possibilities are there to attain some bipartisan support? And I think that, President-elect Biden is seeking to work with Mitch McConnell and to find those areas. But certainly one possibility that I think both Democrats and Republicans are in favor of would be more spending on public infrastructure. So I see that as another area for potential compromise. Okay, where does the compromise become much more difficult to attain? And here I would say that one of President-elect Biden's major initiatives is he wants to tackle climate change. And one of the ways of doing that is to reduce reliance on fossil fuels and to develop alternative sources of energy. So if you like, green energy projects. And his campaign agenda called for spending of as much as more than $1.5 trillion. That's over 10 years, but still a large price tag. Well, I believe that is certainly one area where Republicans and maybe even some Democrats might have second thoughts. So that's going to be much tougher to get through that type of spending with Congress as close as it is. I think then the other additional area that's, of course, important to everybody is that President-elect Biden was seeking to roll back some of the Tax Cut Jobs Act bill under the Trump administration. That was the signature legislation. And basically, what Biden is proposing is to see the top rate on corporate taxes be lifted from 21% to 28%, as well as increases in the marginal tax rate for the highest tax bracket. And he would define that as individuals with or households with $400,000 or more in income. On top of that, there's discussion of whether there would be some rollback of estate tax relief that was granted in the Trump era. So what I would say to you on the tax side of the equation is, I think first of all, it's unlikely that anything's going to be passed immediately. And the principal reason is, if you have the economy hurt by the pandemic, not a good time to be raising taxes right now. So it leaves open the door, though, that later in the year or next year, that the Biden administration could press for tax increases. So, that's how I see the legislative priorities of the Biden administration playing out. And if I just was to summarize and say, so you add all this up, what's the basic conclusion? Well, the basic conclusion is there's no doubt, and the market's anticipating this, we're going to get additional government stimulus. The only question is, how much will that be? If we don't get the tax hikes, we're going to get further large budget deficits. We had a post-war record budget deficit last year of about 16% of GDP. 2021 isn't going to be that big, but it's not going to be small either. And so that's something that the market will be digesting. And I'm going to leave to Dan Carter his take on what that might mean for interest rates and the Federal Reserve policy. Lastly, I do want to just touch quickly on an area that I haven't focused, I haven't seen a lot of other people talk about, and that is how will regulatory policy under the Biden administration look like? And here again, see change in objectives from the Trump administration. The Trump administration believed that there were too many regulations. Let's reduce them. One of President Trump's first announcements was he wanted agencies to cut 2 regulations for every new one that they implemented. So Biden has made clear that especially in the area of the environment, where he thinks that the dereg went too far, he can just make new executive orders. He doesn't even have to pass legislation to deal with some of that. So that's to be expected. But when I go and I say, okay, if I'm an investor in the equity market or even fixed income market, what areas are potentially the most likely to be impacted by new regulations? I would highlight 3. The first is energy. And here again, I highlighted this before. Biden administration wants to reduce climate risk. That means legislation that can affect the use of fossil fuels, especially for cars and the like. At the same time, providing subsidies for the development of non-fossil fuel energy sources. So that's one initiative that will have potentially some impact on the equity sector. I think the second area that will be under consideration is pharmaceuticals, and especially drug prices. And here, there's actually bipartisan support. Republicans as well as Democrats are concerned that drug prices in the United States are too high. The problem was, though, we didn't get a lot enacted under the Trump administration to reduce them, although we did see some slowing of drug price increases. So the real question is, would the Biden administration go so far as to seek price controls on drugs, which pharma would not like and would lobby against? Or might they basically say, well, what we could do, though, is provide more support to Medicare to basically subsidize people who are using pharmaceuticals? I think that's the more likely route. And lastly, just to conclude, I think another new priority area that's really surfacing is, what do we want to do about big tech? And this, to me, is the big question, and Austin will touch on it. Technology far outstripped any other sector of the economy. But when you look at it, technology is 2% of jobs, 6% of GDP, 28% of market cap. So there's been a lot of attention, especially on the progressives in the Democratic Party. Is big tech, do we need more stronger antitrust legislation? And already there's legislation in the works, and we'll see whether that passes or not. I'm still not convinced it will. But another area is simply that some of the major tech companies simply don't pay taxes. So because of their global operations. So again, here, I think there is greater prospect of passing that maybe there's a minimum corporate tax that's got to be paid irrespective of jurisdiction, and then 15% tax rates talked about. So if I summarize on the regulatory front, then these are things that will be more into focus after we deal with the bigger fiscal issues. But in conclusion, here's how I would summarize my message. My message is that this past election had the potential for being a sea change election, meaning the policies of the Trump era, could they all be undone if the Democrats won the presidency and gained control of both houses? Well, that's happened. But my call would be that we're going to get a partial rollback of what happened in the Trump era rather than a complete rollback. With that, I now will turn over to Dan Carter.
Thanks, Nick. So I'll talk about Fed policy and how we think a lot of these issues that Nick brought up are going to impact markets. So when we think about the Fed, it all starts with the economic outlook, and Nick did a great job of laying out the impacts that we see from a lot of the changes that have been going on in the political landscape. Consensus expectations for this year are 4.5 or 4 to 5%. If you think of more optimistic expectations, taking on the full account of the fiscal stimulus, some have moved theirs above 6%. So you often hear the Fed talk about risks to the forecast. Fourth quarter last year, the risks were squarely to the downside based on the risk of the virus resurgence, and prior to the package being passed in late December, inaction by Congress. With the landscape that we see now, I think the risks are, at best balanced and likely moving to the upside, as we go through the year. So to Fed policy going forward, think back to what they've done since March. They've really responded with overwhelming force to the initial downside of the pandemic, lower interest rates, asset purchases, a number of other programs. And fast forward to today, interest rates are still low, financial markets have recovered and are healthy. And so that results in very easy financial conditions, which encourages consumers and businesses to spend, invest, expand their output. A key change that the Fed made last year is going to be very important in the way we think about policy going forward. They made a change to their framework that changes how they think about and will adjust policy related to their two primary goals, which are 2% inflation and full employment. On the inflation side, they have moved to a flexible inflation target. So, prior to this, they targeted a point estimate of 2% inflation. Now they want that to average 2% over time. So a period of below average inflation should be countered with a period of above target inflation. Also the meaning of full employment has now been expanded. Prior to this change, the unemployment rate was often cited as the main measure of unemployment. Now we're going to expand that. And essentially, the way we think about it is they're going to have as many people employed as possible in the economy as long as inflation stays in check. So this is a very broad measure of employment. And so we think both of these changes are going to be very important as we go forward. In previous cycles, the Fed would preemptively tighten policy to ward off future inflation. With the changes that we just talked about, they're going to be more willing to let the economy, quote unquote, run hot until these goals are in sight. And if you look at where we are versus these goals right now, we are nowhere close to achieving them. Inflation has been below 2% for almost 10 years, and employment is substantially below where it was pre-pandemic. We're about 10 million jobs short where we were pre-COVID. So as the economy rebounds, some of the upside risks that Nick talked about from the fiscal side, if these manifest themselves, if vaccines are distributed effectively, the Fed is going to be accommodative. And most observers expect asset purchases of treasuries and other securities to continue through this year at least, and then interest rates to remain at zero at least and through 2023. So for markets, the prospect of healthy growth, stable Fed policy at very accommodative levels, and the potential for accelerating to above trend growth is a tailwind for risk assets. What's this mean for the interest rate outlook? So we've seen a modest increase in interest rates in late 2020 and into this year so far, but in a broad context, historically, they're still very, very low. And I like to separate the outlook into a near-term versus longer-term context. In the near term, it's basically you have opposing forces to the direction of interest rates. Keeping interest rates low is Fed policy. Buying treasuries at a pretty healthy clip, again, expected to continue that through this year. And keeping short-term interest rates low will just exert downward pressure on all interest rates across the treasury curve. On the upside risk, it's the issues we've just talked about. It's fiscal spending, it's effective vaccine distribution, and a strong and perhaps accelerating into the second half economic growth. So this puts upward pressure on interest rates. So I think net those two together, over the near term, we expect interest rates to remain relatively stable around current levels. But as we get into the second half of 2021, I think that's where the biggest risk of higher interest rates comes from. If we do get this acceleration in growth and the Fed starts to talk about maybe reducing some asset purchases, then you could see a backup beyond the ranges that we've experienced here for some time. So with that, I'll turn it to Austin, who's going to talk about valuations and what this all means for portfolios and strategy.
Great. Thanks, Dan. Like I said, I'm going to touch briefly on valuations, portfolio implications, and strategies that we believe are well positioned in 2021. So if we look at valuations, we think they generally reflect the positive economic outlook that was just discussed. Within fixed income, credit spreads have retraced almost all the spread widening induced by the global pandemic and are back to levels last seen pre-crisis. Broadly speaking, valuations in fixed income are near their tightest quartile, meaning compared to history, they've only been tighter or more expensive 25% of the time. This will limit the upside for the credit markets this year. That said, we view the downside is also contained, supported by the improving economic backdrop and reduction in defaults. Interest rates, as Dan just discussed, both nominal and real, are near their all-time lows. While this is good for growth and risk assets, it doesn't bode well for future fixed income returns. And although it's tough to predict the level of interest rates in the near term, it's likely that rates will move modestly higher over the course of the year. As we turn to equities, we actually view valuations as fair. We take a relative view to equity valuations, and when compared to US Treasuries, equities are trading at median levels compared to history. And even though equities suffered negative earnings growth in 2020 of about negative 17%, markets viewed this as transitory and look through to the rapid growth that is expected in 2021. As a result, equity markets will likely still move higher this year, but returns won't match that of what we've seen the past couple years. The consensus target return for the S&P 500 in 2021 is only 6%, compared to 18% in 2020 and 31% in 2019. That's a 56% return over 2 years. It's going to be tough to match that going forward. So in a nutshell, we think valuations are fairly priced at this point and already reflect much of the broad economic recovery that we're anticipating in 2021. So what does this mean for our portfolios? What's the investment implications? So based on our positive economic outlook, supportive financial conditions, and fair to slightly expensive valuations, we're targeting 50% of the risk budget within our portfolios. What does this mean? This means we're using about half of the allowable risk tolerance in each portfolio. We're positioning portfolios for solid economic growth in 2021 and a return to normalcy by the second half of the year. With equities fairly valued and likely to move higher in 2021, and fixed income markets fully valued with yields at all-time lows, we prefer an overweight to equities compared to fixed income. We believe future returns across most asset classes will be lower than what we've experienced over the past few years, with equities outperforming bonds. Within our equity portfolios, we're maintaining a balanced approach, but favor more economically sensitive, cyclical sectors that are trading at fairly attractive levels. These include more value-oriented sectors such as financials, industrials, and consumer discretionary, as well as small and mid-cap stocks. In fact, in 2020, growth stocks returned 39% compared to only 3% for value, resulting in record outperformance of 36% for the year for growth versus value. We believe the composition of equity market performance in 2021 will look fairly different than what we saw in 2020. Within our fixed income portfolios, we have maintained a meaningful overweight to risk since March of last year. But going forward, we're inclined to modestly reduce risk as valuations fully reflect the positive economic outlook, but will still favor credit over treasuries. So what strategies do we think are well positioned for 2021 based on what we've just discussed? So with record low yields, investors are faced with a problem today. And we're having conversations with clients about higher income oriented strategies that might perform well given the current economic backdrop that could increase returns based on those low yields that we see. So within equities, we have both value and income oriented strategies that are well positioned to benefit from the economic rebound in 2021 while providing a higher stream of income compared to most fixed income markets. It's important to note, however, the key to income investing within equities is to not reach for yield in the highest yielding stocks. Instead, investors should be focused on high quality companies that can grow their dividends over time while maintaining diversified approach to investing to avoid unintended exposures. If we look to fixed income, we actually favor multi-sector, more active strategies that have become more popular as investors seek alternatives to traditional core fixed income strategies. These strategies allow for a much more active approach to investing with the potential to generate higher returns from both security selection and asset allocation. Before I turn it back over to Nick, I want to touch briefly on one of the more debated topics of 2021, value versus growth. One of the biggest trends in the US stock market during 2020, as I mentioned, was the dominance of growth stocks versus value. It was a record year where growth returned 39% compared to only 3% for value. Why is that? Well, there are a few reasons for this outperformance, but as we believe, the biggest driver was the shift to digital as a result of the COVID-19 pandemic. This boosted earnings for growth-oriented tech companies relative to their more cyclically sensitive value counterparts that saw their earnings drop as the economy plunged into a recession. As we look forward to 2021, there's reasons to believe that value could stage a comeback. Value tends to perform well in economic recoveries due to their economically sensitive earnings and sometimes cheaper valuations. As we've discussed, as Dan mentioned, our base case is for strong economic growth this year as we return to normalcy in the second half of 2021, bolstered by the prospects of additional fiscal stimulus. This will be a valuable tailwind for value. As we look at growth, we think growth faces several headwinds over the next coming years, largely due to the change in the political landscape, as Nick mentioned, focused on increased regulation and increased taxes. So these considerations make it reasonable to believe that value could indeed return to favor in 2021. But that said, we would still recommend investors maintain a balanced approach to equity investing in 2021, but favor a resurgence in value-oriented stocks and small and mid-cap as well. And with that, I'll turn it back to you, Nick.
Okay, thank you, Austin. And just want to close by thanking everybody for participating today and welcome any of you that have questions to be sure to contact us at Fort Washington. Thanks again. Good day.